Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for April 18th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, reporting live from my basement today. I'm joined by Dean Croak, who's our Principal Industry Analyst. And we have a very special guest. We have Ryan Muhammad joining us this morning from America's Hat. Correct?
I don't know about that one. I might have to leave the show after saying that here now. For the first time we heard, but yes, coming all the way from Canada.
Awesome. Thanks for having us on. I guess we're paying back the favor. I love Ryan. Go ahead and introduce yourself real quick if you don't mind.
Yeah, of course. Ryan Muhammad. I've been in the logistics industry for about 6 years now, working for Wellington Group of Companies. And then on the side, daily host of Sales Chatter Live, where every day at 11 a.m. And then on top of that as well, I do have a show every Monday at 5 o'clock called the Logistics Monk Show. That's kind of my little bit of a moniker. But I've been working really primarily in the truckload industry for the last 6 years. So that's my little bio there.
Awesome. We love coming on the show. Dean's a regular fixture, and I get the pleasure of attending when, in the rare case when Dean is out doing something else, I get to attend. So always a lot of good information, especially right, you're more of a sales audience, right? Sales Chatter Live, a lot of great tips and tricks on how to maneuver markets. So highly recommend checking that out. So for those less familiar, we're here every Tuesday at 10 a.m. Eastern. We got a lot to cover. We're going to be picking Ryan's brain towards the end here for some tips and tricks to navigate this market. So to do that, we're going to dive right into the key points of the week to save a bunch of time for your questions. Let's get rolling here. So a bit of a daunting position, I would say, in the market. We keep waiting for some seasonality to kick in, and it just hasn't yet. Dean's going to cover this in more intricate detail, but where we sit now, pretty much every day, we don't see that seasonality. The year becomes more and more precarious. So again, the first note here speaks to that of spot rates identical to 2019 as produce season starts, ... presumably. Dry van load post and equipment post volumes are about 10% higher than the pre-pandemic average. Our friends up at Michigan State put out their February 23 Michigan State ton mile index. It's flat month over month, down 1% year over year and up 1% over 2019. Cash shipment index down 1% month over month and 4% year over year. And then just a note here about soft retail sales. Ongoing destocking and lower import volumes remain the primary headwinds to freight volumes for some time to come. So with that, I'm going to turn it over to Dean to walk us through our long-form market update. Dean?
Yeah, thanks, Ken. We did get some better news this morning from the US Census Bureau. Housing starts and permits up slightly in March, which is great news for flatbed carriers. So we'll report more on that next week. So let's start our market update with the load to truck ratio and dry van. Volumes are up about 10% last week and now higher by about the same amount as the week 15 average going back through pre-pandemic years. So about 10% higher than what we normally see, excluding 21 and 22. Still about half the volume of what we saw a year ago, though. Equipment posts are about 8% higher than the week 15 average over the same time frame. So we're seeing more carriers post their equipment looking for loads as the market capacity loosens. Load to truck ratio increased slightly to 1.82 last week. In refrigerated, load posts are still around half what they were a year ago. Produce season really hasn't thrown enough volume into the market to move the national needle. In contrast to dry van, where week 15 volumes are higher than the pre-pandemic average, reefer load posts are about 18% lower than the average going back to 2015, excluding the pandemic years. Equipment posts were flat last week. As a result, the load to truck ratio decreased slightly from 2.61 to 2.54. And in flatbed, after steadily increasing for the prior 3 weeks, flatbed volumes reversed course last week, decreased by about 3%. Following our comparison to pre-pandemic years from the other modes, last week's volumes are just under half of what we'd normally expect to see in the flatbed market at this time of the year, excluding 21 and 22. Equipment posts were down last week, load to truck ratio up slightly to 11.95. Having a look at some of our freight markets around the country and our market condition index, in the largest distribution market in the Southeast, volumes are up 9% week over week in Atlanta, pushing Houston out of the number one spot for dry van spot market activity. There was still plenty of capacity in Atlanta last week. Outbound rates dropped 4 cents a mile to $1.60. At a state level, Georgia's outbound spot rates are identical to 2017 and 2019 at the state level. Regional loads, one of the bigger lanes for dry van Atlanta to Orlando, averaged 251 last week. That's the lowest in 12 months and exactly $1 a mile lower than this time last year. Whipping out to the West Coast in California, dry van capacity continues to tighten for the third week following another penny per mile gain at $1.83 per mile for outbound loads. State level rates are identical to this time in 2020. Los Angeles rates increased for the fourth week to $1.56. Loads going out of Stockton up 3 cents a mile to $1.52. And loads between Los Angeles and Stockton, one of the busiest in the spot market in the country, volumes were up 2% last week, but there was little change in spot rates. They've been flat at $2.50 a mile for quite some time. Other Midwest markets, the bigger markets, Joliet and Chicago, rates continued to slide last week, down 7 cents a mile to $1.95. Even though volumes are also down, not by nearly as much. In Texas, dry van rates have steadily fallen for the last month, averaging $1.62. In refrigerated, we're having a look at some of our main produce markets this week. Of course, as produce season warms up in Florida, Miami and Lakeland markets occupied the top two spots for spot market volume last week. Combined, they accounted for 11% of load posts. That's pushed capacity a little bit tighter. Reefer rates are up for the fourth week to $1.78. Remember, folks, these are excluding fuel, so you'd have to add the fuel surcharge to get the all-in rate. Now within 7 cents per mile of 2018 levels. Digging a bit deeper into Miami, spot market volumes were down slightly last week, but capacity did tighten as more of that van volume or van capacity moves into the Lakeland market, where rates are slightly higher. In Miami, rates are up to $1.73, up about 37 cents a mile in the last 2 weeks. So some good value for carriers venturing deep into Florida. In Fresno, one of the bigger markets on the West Coast, rates up 6 cents a mile to $1.66. Volumes are up 38% week over week as that particular market starts to dry out following the recent floods. At a state level, rates are about $2.02 per mile for refrigerated carriers for all outbound loads. That's identical to reefer rates in 2019 outbound California. Wrapping up our market condition index, look at the market in flatbed. Southwest and Southeast flatbed markets accounted for almost a third of the volume last week. Volumes were up 3% in Houston. Capacity in our number one flatbed market continued to tighten for the fourth week, rates up to $2.42 for outbound loads in Houston. At the state level, Texas flatbed rates at $2.33 are the second highest in 7 years and at 3 cents a mile higher than in 2018. The number one flatbed market measured by loads moved is between Houston and Houston and El Paso. Volumes have dropped by about 25% on that lane in the last month. Line haul rates on this lane at $2.32 are about 40 cents a mile lower over the same time frame and about 70 cents a mile lower than this time last year. Some pretty good value for carriers in Shreveport. It was the number two market in the Southeast last week. Volumes up 21%, rates averaging about $2.85 per mile. Having a look at our year-over-year look at spot rates, excluding the fuel surcharge, dry van line haul rates are 9 cents per mile above 2019 levels this week. Remember, that's excluding fuel. Some of you got confused on that last week on some LinkedIn chat. These are rates excluding fuel, but the gap is steadily closing following last week's decrease, getting close, very, very close to 2019 levels. Rates were down 3 cents a mile last week. National average sitting at 163. But remains about 6 cents a mile above where we would normally see spot rates in week 15 going back in the pre-pandemic years. Based on the volume of loads moved, the average rate for the top 50 dry van lanes was 21 cents a mile higher. The top 50 lanes averaged $1.84, excluding fuel. In refrigerated, line haul rates recorded the most significant weekly decrease since the start of February last week, down 5 cents a mile. Identical, though, to the weekly reduction this time last year. At $1.93, excluding fuel, the national average reefer line haul rate is just 4 cents a mile above where we were in 2019. And wrapping up year-over-year look at spot rates, flatbed rates were flat last week, national average of $2.17 a mile, and have been within about 2 cents a mile of this level since the start of March, so pretty much flat for the last 8 or 9 weeks. The average is 16 cents a mile lower than in 2018 and higher by the same amount than in 2019. So that's it for our market update this week. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our long form weekly report, which will be published this evening. And with that, it's over to Ken for the short-term forecast.
All right. Thank you, Dean. Let's get these forecasts up here. All right. So for those less familiar, we do this every week. These are our 35-day outlooks, and we usually bring in several months of history to show how that trend is moving. Right here, it starts at November 1st of last year. The blue line is the historical average. It does not include fuel, and it is a 7-day weighted moving average. And then we have 4 forecast models. We have RateCast in green, which is our flagship forecasting model. It's in all of our products, the RFP tool, RateView, etc. We have the red, which is a short-term model, which more heavily weights kind of rote seasonality and short-term impact. And then you have the gray and the yellow, which are intermediate blends of the two, I would describe. And what you see here is, if you remember, we had quite a bit of forecast divergence the last few weeks. And even the models at this point are starting to get worried, to the extent that a computer algorithm can get worried. The Raycast is essentially pulled back into line of no more downward movement because of seasonality. And the other models refuse to believe that seasonality isn't going to come back to the market. So if I were practicing moving freight out there at the moment and not studying it from behind my desk, I would recommend somewhere between these lines, somewhere between the green line, and depending on how optimistic you feel about seasonality or what market you're operating in, one of the other 3 upside scenarios over the next few weeks. Let's take a peek at reefer next. A very similar story here. You can see that yellow blend, one of the 4 blended forecast models, gets out to quite a hurry there. I think that's really just an artifact of it not believing that we're in the current state. If you it's jumping off from a point of where we were earlier in April, not where we currently sit now. But again, most of the models are showing a flooring effect, varying all the way up to pronounced recovery due to seasonality. And then to end on some agreement, we're going to go into flatbed. Pretty much all the models here are in agreement that we're going to stay relatively flat through the end of this month and then start creeping up as we get into May. And I think it's a pretty safe bet, given all the signs we're seeing in the flatbed market, other than some really surprise heavy manufacturing or home building or borrowing data. I think this forecast is going to hold not only for the next 35 days, but this pattern will most likely continue into the summer. I don't think that's a hot take. I think that's just pretty much consensus among industry experts. So we're going to bring Ryan back now and get to our question of the week.
Yeah, thanks, Ken. So Ryan, based on your extensive experience in the field, what are some of your tips for managing the broker-carrier relationship?
Yeah, I think there's a lot to kind of go with that. And for me, the number one thing is just having like communication. So what I see a lot of is you kind of see it on LinkedIn and different things like that. People are just kind of, they're upset when the market turns or when it goes either your way or the other way. For me, when I kind of started as a broker, in terms of going cradle to the grave model, I relied on my carrier partners so much. So I relied on the spot boards, I relied on those low boards and go from there. But then after I got into kind of groove of like 6 to 8 months building my book of business, I understand that communication and transparency and honesty are like the top 3 things for me. And I guess that can be said for everything else in life, right? But you know, there's so many times that I've seen carriers where you book a carrier in, broker doesn't give them all the information that's on at hand, whether it be first come first serve or different appointments, and then they just show up there and then they're kind of left on an island by themselves. I don't operate that way for me. And I would hope that we kind of shift that mindset, because it starts with training as well. Right. I know when I started off as a logistics coordinator in this industry, we would talk with different carriers, but my boss would kind of tell me like, hey, make it seem like you have the load in hand, even though we're just trying to get a quote. So just imagine someone who's maybe like 20, 30 miles away, expecting to kind of get this load and kind of close this and being that good phrase of, hey, I'll give you a call back. That never has worked for me. So I think like being honesty, the things that we can control. I don't drive the truck myself, as Dean, you have the Grumpy Pete and things like that. And you've seen and have conversations with these truck drivers at different truck stops and things like that, that what really annoys them. One thing that I've kind of learned from managing the relationship is that on our show, we had empowering women into driving. So we had female drivers come on our show and talk to us about what they faced and kind of get their opinion of everything that's kind of going on. And one of the things like facilities, like why can a driver not use a bathroom, and why can't they get unloaded properly at a time, right? And I think it has to go both ways. But when I manage my relationships, I treat them more important than I actually do my shippers. And I know I probably shouldn't be saying that, but they're the reason why they're my image, credibility, and brand for my customer. So for me, I don't operate transactionally. My freight actually doesn't hit any load boards itself. I kind of have my core group of carriers that I just maintain relationships and keep on going with that.
First of all, that's deeply offensive as the operator of the largest load port in North America. No, I'm just
Sorry,
kidding.
I apologize.
I think one of the best analogies I've heard of the brokerage industry, and I want to try it on for size with you a bit, is when it comes down to a restaurant, right? You can treat your customer, you can have the best table staff in the world, and if you're serving them day-old chicken McNuggets, it's no good, right? And that analogy, right? The ingredients, the product is the carrier, and the experience is what you're giving to the shipper, and it really requires both. All the best restaurants in the world have great ingredients, great food, and then they also have great service. So, do you feel like that holds? And like, how would you bend that analogy to get it to fit our industry more precisely?
I think it does, and I like that. I think I've heard the other analogy is like, hey, you're making a soup. You're trying to put the best ingredients in the soup, and you're just trying to have like something that's like healthy and hearty at the end of the day. And I think when you said that, think about it as a restaurant. You got your ingredients. If you're getting day old nuggets, the one consistency that we always kind of see, I can go to McDonald's in Dubai, I can go to McDonald's in America, I can go to McDonald's in Jamaica. It's always a Big Mac is going to taste like a Big Mac, right? And it's that consistency, I think, which you kind of base your foundation with. So if you're somebody who says, hey, I'm about the carriers, be honest with them, because I think I was reading comments like, like shippers are paying like $5,000 and like the carrier will only get like 1,500, where it's like, come on, man, that's not going to last long. That's not how you do business with people. Imagine if that happened to somebody like you, but I guess people are paying like the target market rates on that point. But I just like to kind of deal with integrity. So that's why I said carriers are everything to my business. Without them, I don't even know. I don't have a CDL. I can't drive, I can't go pick up this load. But at the end of the day, I'm going to be that person who can connect those people together.
Yeah.
Yeah, there's nothing
We
worse
had a guy. Go ahead, Dean.
Sorry.
No, go ahead.
I said there's nothing worse than being surprised. Carriers hate surprises, and truck drivers are a fairly resilient, creative, innovative bunch. They can solve almost any problem that's thrown at them. But one thing they don't like is surprises. If you could tell them all the good and the bad before you get to a load, things will be much, much easier for all parties involved. Sorry, Ken.
No, I was just going to say, we had someone when I was at FedEx that went and got their CDL kind of just to be cute, and realized that comes with a lot of extra scrutiny when you're having a roadside stop for speeding, even if you're in your passenger car.
Just to add to what Dean was saying about like surprises, it's even yourself, right? It's like let's talk about the restaurant. You go into the Keg, which is like a steakhouse here in Toronto, and you order a steak, medium rare, and it comes well done, right? How are you going to react, right? You're going to be reacting that this is not the right way that we kind of do business. So, I've seen it, and I've been unfortunately a victim of it, where I've kind of seen that, hey, you tell a carrier to kind of go in, and then they don't have all the things there, and then they're blowing up your phone, and then you're like, all right, let me just turn this phone aside. Let me put it on Do Not Disturb. That's not the way you do business.
Yeah.
No, the thing that we find, so we're about to go to TIA this week, right? The largest brokerage conference. And I think they're going to set all attendance records this year. They're pushing up against 2,000 attendees in the bastion of American capitalism, no less, Orlando, Florida. I think there's been what I would call like a secular shift over COVID, where shippers are far more willing to put a broker in the routing guide than they were before COVID. Yep. We have qualitative and quantitative evidence to support that. We talk to a lot of shippers. I think a lot of brokers are trying to figure out how to make that shift permanent. And when you talk to them, pretty much everything you said, Ryan, is whether you're the largest brokerage in North America or you're a small agency shop or you're trying to make it on your own, it's like, we need to make sure that they are getting the best experience from both a shipper and a carrier side. Because if I lose my carriers, I provide no value to the shipper. And if I lose my relationship with the shipper, I have no freight to move to keep my carriers moving. So it's like, I think brokers are acutely aware, especially in this market cycle, that they need to make sure that they're delivering excellent service to both sides, because they don't want to shift that freight back.
Yep.
Right. Look at what JB Hunt. I think JB Hunt, I read this morning, I could be butchering this, but they went from 46% contract same time last year to 64% contract now. Right. So like that's the direct relationship with the shipper. And it just becomes incredibly important to make sure that you're delivering on those commitments and giving that consistent experience.
And yeah, just to add to that, I think it's really important. So I think like what you were saying, like I have capacity to sell when I talk to a shipper. So for me, when I go into a shipper, I'll be like, okay, well, I legit have these capacity. I don't say, hey, I got 500 trucks driving in your area. Nobody has that. But like I actually have capacity. Does this fit in your wheelhouse? Yes or no? If it's a no, then I'll always ask them, hey, do you know anybody in your area? Because like you're talking about TIA, there's always these shipper conferences, food shippers and Roof Tech that I went to a couple of weeks ago, that shippers are talking to each other. So it might not be a fit for customer A, but I might be a fit for customer B. And I think like when we're talking about carriers, I like to bring them into the fold, just like I bring my operations into the fold. I operate, and like a lot of people don't operate like this, but I operate like a cost plus on dedicated and spot, just because like I'm not trying to buy like a new Tesla or like that. I'm just really trying to pay my bills and leave a mark in this industry that's fair and have integrity.
Yeah, that's a. I mean, a lot of carriers are probably, they're worried about things like transparency now, broker transparency, but of course that's a two-way street. It generally happens where carriers are concerned about transparency when rates are low, but really when rates are high. So the core of what you're talking about is building good partnerships. Carriers are looking for good relationships with their brokers just as much as brokers are looking for good partnerships with their carriers, because to your earlier point, you can't subcontract out customer service, right? So when you use a carrier in your business, they are your frontline person. So this is that's something that newer carriers to the industry don't really appreciate. Because whilst a seasoned carrier will want to build a relationship with you, there's always someone that has come into the industry that will undercut them and offer a lower level of service. And that's sort of where we're at right now with so many new entrants in the industry. It's been a little bit of a race to the bottom, and service has suffered, I suspect, dramatically for shippers.
Yeah, I couldn't agree with that more because and that's the reason why like I have my own requirements for carriers that I use. I won't go over that, but like I feel like with the new guys kind of coming in and things like that, we've got to understand this is a service focused business in an industry. I always kind of tell people like I worked at a telecom company for customer service for about 7 years before I got into logistics, and I found that like the transformation from going from there to like logistics industry, it was actually very seamless because I was able to bring my customer service and have that forefront. And I think like when you're talking to like different carriers, I don't know how it is kind of like in the States because I don't do a lot of like US domestic stuff. I do more cross border and within Canada. So what we've kind of seen is that it's always kind of like the same carriers that you're going to go after, or you talk to a carrier who's moving to the shipping location, they know exactly where they're picking up before they even get the rate con and things like that. So I think once you kind of have those open conversations and able to kind of talk about, okay, what are you guys kind of seeing in the market? Because yeah, everyone talking about when the rates were high. I don't blame my carriers, and I'll be a broker by saying this. I don't blame them for going to get more money. Like at the end of the day, it is like we all got to provide for our own families. So if it was like, look, Ryan, I normally do this for you, but like a customer here is paying me X amount, I was like, all right, man, you got to do it for your family, and that's what I think. I don't take anything personal. I've seen like brokers like get like a black book and they kind of write down these carriers on the list, like blacklist them all that stuff. It's not that serious, man. It's just life.
I mean, I think the one thing we all need to keep in mind when we're talking about transparency or when the market swings the other way, price gouging coming from carriers to brokers and shippers, this industry will fall, like the intermediary piece of it specifically will fall apart without the relationship aspect, right? If all three sides hunker down and take a strict adversarial approach, everyone loses. I mean, this is an industry, this isn't parcel where you drop something in a box and then a faceless, nameless driver comes and picks it up once a day and puts it in the back of a truck, and then this entire machine, right, this coast-to-coast apparatus spins up that gets your package to your door. This is, it didn't have noted in the bill of lading that it needed pads and straps or this and that. And like, what do? Do you just sit there? I think long and short of it, we can spend hours probably talking about this, but the long and short of it is, this is not a fully commoditized market. It has a lot of aspects of a commodity market, especially with such a robust and healthy spot market. But to be a true commodity market, barrel 1 of oil needs to be exactly the same as barrel 1 million of oil, right? And that's not the case. FAK really doesn't exist in its truest sense, right? Even if you have 5 truckloads picking up on the same shipper on the same day, one of those could be a little bit different.
Right.
And we've all experienced it, right?
Yep.
Dock door 3 might be a little bit slower than dock door 1, 2, 4, and 5, and you might get a little bit of a later start, which puts you over your hours. You may need to do a personal conveyance. I mean, there's just like, we've all worked through these, and the only way to manage through it, in my opinion, is through relationships.
Yep.
Yeah.
Hey, Ryan, we were sort of coming up towards the end of the show, and before we get to questions, tell us a little bit about the Canadian freight market and what sort of things you see in the cross-border world.
Yeah, of course. So the Canadian market, we go through that seasonality. I would love to say that it's relatively the same because anytime I watch like the show and like have you on Wednesdays, we haven't seen like the race like haven't really changed so much. Like you said, the newer entrants, they're going to kind of gouge a little bit, but for the Canadian market, it's very consistent. I would say there's tons of freight to be out there, and I would say just doing from both sides, I find it's easier to talk to Canadians than talking to like Americans in terms of like getting freight, because I feel like from my point of view, talking to Americans shippers, they're very focused on asset based. And Ken mentioned too that during the COVID and everything like that, people are more inclined to add a broker to the list. Well, in Canada, it's mostly 3PLs anyways. So being able to go into a shipper and say, hey, I might not know how to bake a Black Forest cake, but I can find you the best baker in Toronto. Might not know how to nail in the wall, but I can find you the best carpenter out in Quebec as well. So with the Canadian market, I always find like it's usually kind of like the same shippers, the same freight kind of going, and there's very consistency. But with that though, you understand that because there is that consistency, you're going to be taking accounts away from somebody. So that's where the customer service comes in really big, because any account that's lost, any new customer that you get, you took that away effectively from somebody. And the cross border, I would say it's a relatively same thing. I think it's been a little bit slow on my end. I got one of my biggest customers. They do like mineral salts. So they'll do like table salts, and then they'll do pool salts. And they said for road salts this year, there wasn't enough snow. So their projections and their forecasting went through the window. And like even for pool salts, it's like, okay, well, we'll get ramped up in a month or two. So I think when we're looking at projections, people are able to bring on different brokers, and I hate to say this word, but they're willing to try them out and then see what they kind of do, and then kind of fire themselves if they kind of go from there.
Awesome. So when we move on to some listener questions, we have quite a few stacking up here.
Yeah, you might start off, Ken. I'm just trying to pull them up. Here we go.
All right. So from JCB, do you expect a capacity shift with dry van operators shifting to flatbed? Dean?
I mean, the premise there is that that's happening. I'm not sure. I mean, I guess I do. I mean, my experience is very limited to only the drivers I know. And yes, some have moved over to flatbed because the rates are higher. But it's not as easy as moving between dry van and reefer, because you've essentially got the same trailer with the temperature controlled apparatus. Flatbed's very different because of the amount of extra material you need to secure loads and tarp them, plus the experience to haul a wide variety of machinery and equipment and steel. So I don't see that transition being nearly as impactful in the market. There is always capacity migration across modes. There's no question about that. My first reaction to the question is I don't think so. I don't think it'd move the needle, because I just don't see it happening that much.
I think this is always a fallacy. This always happens when the market gets really, really slow. People presume that they're just dropping a leased on, extra lease trailer in some trailer pool and then going to haul heavy to Conestoga. It's like, I don't think so. It does happen, like Dean said, there's no doubt about it, but it is, in my experience, very, very, very limited.
Yeah. Well, it's one of the toughest, like dry van and reefer is relatively easy compared to open deck, where you've got to know how to chain and secure steel and double tarp if you've got to, and just make sure stuff doesn't fall off. It's incredibly difficult. And having been on the wrong
end, that's the SOP. That's the summary of the SOP. Make sure stuff doesn't fall off.
Yeah. There's a marble maker in Australia that's still angry with me after I put 22 tons of it on the side of the road one day. A story for another day. Next question from DJ. What's the best way to find a carrier if you are new to dispatching? Good one for you, right?
That's a great question.
Yeah, I love that one. So I'm a big believer on knocking doors, and we talk about relationships a lot. So if you're new to dispatching and you want to talk to carriers, because that's essentially what they do. I've seen it. I've seen the influx during COVID of dispatchers coming out. So for me, what I would do, I was literally find out who the carriers are in your area and literally go knock on some doors. You got to bring value to them as well. Like tell them exactly what you do. Take some coffees, take some donuts. I'm a big believer in doing the door-to-door thing. I think that's you can do the phone calls and all that stuff, but you really need that personal touch, especially when you're selling yourself, being new to dispatchers as well.
I wonder, is that DJ Flores, our good friend?
Oh, yeah.
Could be.
He's a Northeast Ohio local.
It is. That'll be DJ, right?
All right. Andrew Webb, other than seasonality, why the optimism in the model? I can kick this one off, and then I'm interested in your opinions. But pretty much all of the fundamentals would indicate that it can't go much lower. And there's a small caveat there. And just bear with me for a second. I'm of the belief that the market may be actually better off. If you take a 12-month view, the market actually may be better off if we see a short and sharp 7 to 10% decrease in rates over the next couple of weeks. Because, as painful as it sounds, I think it would caused such an extreme exodus of capacity. We're talking on the order of 2 to 3, maybe pushing 4 nominal percentage points of latent capacity, that it would kick off the new market cycle in line with seasonality. I think what you're seeing more likely is going to happen is rates stay relatively depressed, and it's more of a slow burn, is what a lot of customers are telling us that they're describing it as. A lot of the big brokerages are penciling in risk more around the slow burn scenario, where rates they maybe come up a little bit seasonally, and then just hover there, which is going to just slowly attrit a smaller numbers. We probably need to hit that 1 to 3 pushing 4 basis points decrease in capacity for the market to fully right itself. And the question is just how fast do we do that? So the reason for optimism is because any more pessimism in the market will almost mechanically flip itself back. So I hope that makes sense. Dean, Ryan, thoughts?
Yeah, I'm in agreement. Yeah, sorry, go on, Ryan.
Yeah, I was just gonna say I'm in agreement with you, Ken. I think that's exactly what's gonna kind of happen. Like, I met with a carrier yesterday, and they've kind of explained to me, like, they've considered like this first quarter and the second quarter as well as kind of like the recession. So it's like you got to bounce back. You can't like live in a recession. It's just not feasible, right? So it does have to bounce back.
Yeah, my optimism is largely driven by the seasonality that we expect to see. Some of the indicators are, starting to warm up. So I'm not as pessimistic as others in the market. I think seasonality will emerge this year. So I think that's our last question. I have one question for
Ryan. We have a couple on
Ryan.
LinkedIn that we didn't get in. We have a couple on LinkedIn. I'll just read since we're running a little bit fast here. I want to make sure I wouldn't want to skip over the illustrious Jeff Dickinson who asked the question. Of course, we would never want to do that. And it was specifically to you, Dean. It was, when do you think the bottom will hit? We talk about this a lot, and I think we have a ways to go. What are your thoughts?
Yeah, it's a tough question. I thought it would have happened by now, Jeff, to be honest. I think this quarter certainly will see it. I can't narrow it down any more than that. But if, as Ken said yesterday on another call, if we don't see something happening by Memorial Day, then we've got a whole nother different discussion happening. So I think in the next 2 to 3 weeks, we should see it based on some of the signals we're seeing this week, Jeff.
I'll add, I'm curious what Jeff thinks, and maybe we can listen to Sales Chatter to get a follow-up on this. I don't know that there's much room for it to go down, right? I think we're pretty much at or near bottom. The question is, how long do we stay here? So I'd be really interested because Jeff has been known to teach people a lot about the freight market. I'd be really interested to see his perspective if he thinks there's more room to come down, because that would be, I would appreciate that as a data point, because I value his perspective.
Ken, he's our guest on next week's show. That might be the question of the week for him.
Wow, look at that.
Yeah.
We'll all be sunburnt coming back from Orlando. Okay, we're going to do some rapid fire questions.
Yeah.
Azam K asked, do you guys have a formula for cost per mile for carriers? I know, Dean, you have general thinking. Can you give us like a 20-second and then point us to where they can find some more data?
Yeah, I've got a blog post coming out next week breaking down all of the costs per mile P&L line items with a chart showing what break-even costs have been going back 3 years. So look for that on next week's blog post next Tuesday.
All right, Ryan, with you, rapid fire, 30 seconds. What's the best way to differentiate yourself when building relationships with a broker? I'm guessing being asked from a carrier.
Yeah. Okay. Yeah, definitely. What I would do is definitely the same thing I said with dispatcher. Reach out to them, make an impression on them, and I feel like you got to have the synergies on in there too. So offer what you can offer. Be transparent. So if you actually have trucks, say the lanes that you actually have trucks on, because we don't want to get into those double brokerage aspects. But I would say definitely reach out, make an impression, see them in person if you can.
Yep.
Awesome. Yep. Thank you. Dean, want to bring us home with some plugs?
Yeah. One more quick question, Ryan. Favorite WWE wrestler of all time?
All time. If you smelled The Rock. I always got to go with The Rock. The Rock was always my guy from the beginning. Nation of Domination. So The Rock, easily.
Wow.
If you I'm an Undertaker guy myself, but
oh wow, okay. I'm on the Iron Sheik side. I love the boots. I can never get past the Iron Sheik's boots. He was on WWE Legends this week, so it was just good to see him. Still,
the biography on A&E. Yeah, I've been catching those. Those are pretty good.
Yeah. All right. Shout outs for this week. Of course, TAA is on. We'll be on tomorrow with Ryan and Jeff Dickinson and Dan Deegan on Sales Chat, 11 a.m. Eastern. We're on Landline Now tomorrow evening at 7 p.m. on Sirius XM Channel 146 Road Dog Radio. Robert Rouse will be doing our weekly update. Don't forget this week's edition of Freight Vine has special guest Mike Kilgore, founder and former CEO of Chainalytics, talking supply chain modeling in general and how the industry is evolving. TAA, don't forget this Friday night, we're sponsoring the big event at the Hard Rock Cafe, 7:30. Let the good times roll. We'll see you in Orlando.
All right. Yeah, we're at booth 401. Just look for the DAT army that's going to be descending. I think we're sending over 60 some people. It should be a really, really great event. I checked the weather. It's going to be beautiful. Just stop by, say hello. You won't be able to miss us. It should be a really great event. And then I want to give a shout out, a special non-freight shout out to the class of 2023, cohort 22 at the Fisher School of Business at The Ohio State University. Congrats to everyone. We all graduated last weekend after 18 grueling months in our program.
Well
so
done.
congrats, everyone.
Well done.
Congrats.
And go Bucks. All right, we'll see everyone later this week.
Okay. Bye, everybody.
Bye.
Take care. Thank you.